Hi there, Kristen Cooper, your certified mortgage planning specialist. Just wanted to jump on here and talk about the market. There's so much going on that I wanted to give some insight as to what's going on, where we're at, and best practices moving forward. So what you're looking at here is mortgage-backed securities. So it's a snapshot of mortgage rates, how they're traded, how they're doing each day. Each candlestick, which is what you see here, whether it's red or green, is what happened that day. So red means that day interest rates were worse, meaning higher interest rates, and green means that day interest rates were better. When we're higher up on the chart, that means lower interest rates, and when we're lower on the chart, that means higher interest rates. So as you can see, back in December, we had lower rates here. We had a lot of volatility, meaning a lot of movement up and down each day. And then you could see February, beginning in February, we had a huge decline. And so again, going down means worse interest rates. So we saw interest rates go up over a point just in this month time frame. And we see, try to recover, kept coming back down, try to recover. And then you could see back here in March, you kind of, if you look at my blue arrow here, you could see the downturn, and then you could see that we started to see a shift back up, meaning better interest rates. So we're seeing a ton of volatility. What's going on in these last couple of days, and you can see here at the end, the yellow means today. So today we're seeing a little bit of a recovery. These little yellow upside down triangles that you're seeing here means that it just was an alert that we needed to lock because we were anticipating worse rates could get worse. So you could see that's a lot of volatility just in a couple of days. Now we had the Silicon Valley Bank issues that happened, the collapse, and a lot of that is due to be because of the Fed fund rate. So what happens with the Fed fund rate is when the Feds increase the Fed fund rate, which is short-term money, it has nothing really to do with mortgages, although there's some influences that it has. But Fed rate is short-term money. So that's like banks borrowing between each other, equity lines of credit, anything that's short-term, not a long-term mortgage. Now, banks and companies lend money or they borrow money, and it's not a fixed rate. So they can't go in and say, hey, we need money for our company, or trade money between banks or any of that and ask for a 30-year fixed rate like a mortgage. It's all adjustable. So when the Feds increase those rates, it's more cost to all these companies, lending institutions. And what happened with the Silicon Valley is that people started to, take their money out, and they didn't have enough money to be able to cover it because they're spending more because of the Fed fund rate being increasing. They have to spend more to keep functioning. And so that's what you're seeing is that it's showing in the effects of what the Fed fund rate is doing to these companies and to these banks. And so we're hoping that the Feds can step back when they have on the 22nd is the next meeting that they have to see what's going to happen with the Fed fund rate. We're hoping they can take a pause for a minute, or at least slow down the Fed hike, because what it's doing to, the banking system, to the companies, is a bigger negative than what they're trying to accomplish, because the inflation number that came out this week actually showed better. And so that does say that, okay, you've already started to see that this is working. You've already increased the Fed fund rate. We are seeing people are spending less money. We're seeing that there's less people that are have jobs. There's more unemployment. There's all of these things that are happening to show that the economy is slowing. So they're almost, like they say, they're over medicating, meaning if they continue to increase the Fed fund rate, then it's just going to have more impacts. And so that's why you see so much volatility in here is investors don't know what's going to happen. Are they going to pause because of what's happening? Or are they not? But this is a direct impact because of the Fed fund rate. Now, with the inflation number coming out better than anticipated, that's a great sign that the market is reacting. And so what happens is when people start spending less money, interest rates are going to drop. So when inflation comes down, interest rates come back down. When we're in a recession, interest rates come back down, but the housing stays stable. So this is a great opportunity for people that are looking to buy, because there's going to be this, and every single time there's this correction where it goes right back. And so you're going to start seeing that the pivot is going to be back to where we were back in 2020, 2021, meaning that when the interest rates drop and all the buyers go back in the market, it's going to drive prices higher. And the reason why is because we have such low inventory that it's going to support housing prices increasing. Now, even right now, with interest rates where they are, there's still buyers that are buying, and homes are not sitting on the market for very long because it's low inventory. So when there's high demand and low supply, it's going to foster stability within prices, which is why we haven't seen prices come down as much as people would expect with the interest rates being higher and everything going on. So there is going to be this window of opportunity, and it's going to quickly change to where right now it is higher interest rates, although as you can see here, we've seen some recovery, and let's say that, hope that it continues to stay, that we've seen this recovery window. But when we do see interest rates start to continue to trend downwards, that's when all the buyers that are on hold right now, that are going to be back in the market, that can afford to buy when rates come down, but it's going to drive up prices, and then we're going to be back to all the, the bidding wars, less negotiations. So depending on what type of market you want to purchase in is really going to be the indicator of, is it the right time for you to buy today or not? But wanted to jump on here and just explain how this is, the market is impacting. You're hearing so much stuff in the media and the news, and a lot of it is not factual. It's not actual data. Unemployment, rates that have been coming out have been skewed because of additional information that have been put into those. And so you're only seeing the other side of it, not the true impact. I've been in the mortgage industry for over 20 years, so I'm studying the data, the charts, and you can see all the trends every single time. It's the same trend that's going to happen, to where when inflation comes down, rates come down, more buyers in the market, drives up prices. So if you're able to afford in this market, it's a great time to buy, because you're going to get the home for the price today, but be able to refinance, which means pay off the loan that you have now and get a future loan at a lower rate when interest rates do come back down in the future. But wanted to jump on here and explain the impact. Also, if you have any questions, reach out. I'm happy to give you some additional information and commentary specific to you, as everybody's situation is different. I do think there's some people that should not buy in this market, but it really just depends on where you're at, what your goals are, and what your intentions are long term. There's never been a time in history where there hasn't been an appreciation over a 10-year span in housing. So you're always going to have this as the safest investment to hedge inflation. And that's why a lot of investors actually put a lot of money into real estate, knowing that that's the fact, especially with everything going on with all the banks and whatnot. So if you have any questions, again, please reach out. The first step is just to reach out. Let's have a free consultation, discuss your options. And then from there, we can see if it's the right time for you to buy, create a home buying plan, and get you on that journey to homeownership and building wealth. Again, Kristen Cooper, you can reach me at KristenLoans.com. That's KristenLoans.com.